Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 5th of September. I'm Daniel Lam, your host for the podcast. Yesterday, I spoke about how Manpreet Gill checked up on me regarding a typhoon that just hit Hong Kong. I told him that apart from getting stuck at home and throwing stuffed toys into the air with my son all day long, I was doing okay. I then remembered those pre-parental days, that I would have all the time in the world for myself. So I sent him a video clip with the classic scene from The Matrix, where Morpheus was offering Neo the choice of taking either the blue pill or the red pill. Now, one of which would let Neo remain in the fantasy world generated by the Matrix, and the other one would wake him up to reality. Now, for those who have been through the topsy-turvy ride in Chinese equities over the last 6 weeks, it has been very easy to lose track of reality and stumble through emotions. Now, yesterday, the Hang Seng Index broke above the key resistance level at 18,800, which we highlighted in the podcast back on the 24th of August. So is there further room for Chinese equities to move higher? Or is this just one of those, yet again, false breaks? But the key point to highlight here is that foreign equity positioning in Chinese equities have crossed capitulation levels, as shown by the monthly northbound net flows on China's Stock Connect program. So despite the introduction of new policy measures, outflows continued and accelerated in the second half of August. In fact, this outflow had now surpassed what we saw back in April and October in 2022. Meanwhile, mainland investors have been net buyers of domestic equities in the month of August. There has been a rapid increase in locally domiciled ETFs and the Stock Connect southbound flows. Regarding the ADRs, reduction of short positions may take place if investors take the bad news is good news as their mantra for the next few weeks. Actually, we already saw such reaction from risky assets over the latest US non-farm payroll numbers last Friday. And we may see more of such price action if the US data were to be slightly below expectations, but still healthily above historical norms. Overall, we could well see a positioning-led rebound in Chinese equities over the next few weeks. Key resistances for the Hang Seng Index are at 19,350, 20,865, and then 22,700. However, for a more sustained rally, one would need to see how these targeted stimulus may help revive areas such as properties, helping shadow banking, and also the underlying demand in the economy. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.